Liz, welcome back.
Hi, Justin. I'm glad to be here.
Heck yeah. Awesome. Thank you so much for coming in again. We just really appreciate you. You are awesome out there. You're doing so much. You're helping so many people in Southern California in the Inland Empire area. So just really appreciate you spreading your knowledge and just helping all the consumers out there.
Thank you.
Of course. All right. So today, what we're going to talk about is the myths. There's a lot of myths around real estate. People just, and it is what it is. There's a lot of information out there online. And a lot of times people can simply just get the wrong idea about the process, the systems, and just the information in general. So one of the things that comes to mind, one of the first myths that I can think of is the fact that a lot of people out there think they need to have 20% down when they purchase a property.
Yeah, it's amazing. You would think by now that people would know that you don't have to have 20% down. So you can get into a home with as low as 3.5% if you're doing an FHA, 3% on a conventional for a first-time home buyer. There are a lot of programs to help with down payment assistance. So if you do not have the funds to get into a home, there are plenty of options out there. The difference is you just have that added mortgage insurance premium.
So is that why that myth exists, do you think? Because I think if a buyer does put down 20%, then they do not have to pay that private mortgage insurance. Is that the case?
That might be. I think that, financially, right? People say, let's have 20% down to get into a home because it makes more sense. Why pay that added mortgage insurance premium? But for a lot of people, it's really just about getting into the home and beginning to build wealth.
Got it. And, to that point, my real estate team, I'm with Keller Williams College Park, which is Upland, and I'm on Stein team within Keller Williams. We actually just got one of our clients into escrow for 0 down.
Yeah.
So the way we did that was, it's a first time home buyer. So they were able to take advantage of one of the credits. It's a down payment assistance credit for first time home buyers. So they still have to pay that money back, but they didn't have to come up front out of pocket any money for their down payment. In addition, there's closing costs that buyers have to think about. So what we did, we were actually able to get a credit from that seller to pay for the closing costs. So that first time home buyer down payment assistance covered the down payment, and then the seller credit covered the closing costs. Our client paid 0 down to get into this house.
That's amazing. Yeah. And you can make that happen. If you're able to get the seller to pay your closing costs, you can get in with 0 down. So that is awesome.
Awesome. So, hey, debunking myth number 1, you do not need 20% down. So what other myths come to mind when you think about just misinformation out there?
The media likes to talk about the housing bubble,
oh
right?
My gosh.
This mystical bubble that's coming. So I would say that the market is not going to crash. We can just debunk that now. I know that the elephant in the room is that we do have a recession coming, and likely, yes, I think that by the end of the year that will be happening. But if you look historically, if you go all the way back to 1960, we've had 9 recessions since then, 8 of which the housing market either increased in appreciation or stayed level. So that's what we have to look forward to. The only one where we saw a recession where the market came down, the market crash was actually what caused the recession. So it wasn't the other way around. It wasn't a recession caused the market crash. It was because we were writing those subprime loans, right?
So you're talking about 2008?
I am. Yes. Okay. Yeah. Don't want to go into the weeds too much about that, but yes. So 2008, we were writing subprime loans, 580. Credit score, no credit, no income verification, nothing. So we also had an overabundance of homes in the market. I think at that time we had about 4 million properties available and on the market. As of today, we're at about 500,000.
Wow.
So it's very different. We're talking about a completely different market moving into this next recession.
Got you. Yeah, I hear that all the time too. I have so many friends and clients out there waiting for the market to crash. And I am just going to have to echo what Liz said. If we look historically, I have this little graph here. It might be kind of hard to see, but I'll be able to show this to you. Prices have simply gone up. This little dip right here was 2008, and we recovered about 5 or 6 years later. And right now in July 2023, we're at an all-time high. I think that what people need to view real estate as, well, I should say it this way. People need to view real estate as the long game. And, there might be little dips here and there, but it really is the long game. And it's a strong, resilient market that continues to appreciate. So I'm with you. Even if certain crashes happen, your investment is safe long term.
Yeah. And, I like to say it's called 73, 7, and 1. So you had 73 years of appreciation, 7 years of losing the equity, and then 1 year where it stayed the same. So if you look historically over the last 81 years, you have a really great shot at building equity.
I love it. Awesome. Let's see. Can you think of any other myths out there, Liz? I can't think of any, but those are the two big ones.
Those are the two big ones. I would say.
Yeah, I guess that's it. Well, if you guys can think of any others, we're happy to, sit down with you, talk about it all, and get you comfortable and get you the right information about real estate. Well, thanks so much again for coming in, Liz. I always appreciate you. You're such a stellar.
Thank you, Justin, for having me. It was fun.
Awesome.
All right.